You don't need to look for a 10x or a 100x right away. You can just look for companies that have a long-term successful track record, learn how to read financial statements, and you're good to go. Like many people, I started as a gambler, not as a real gambler, but figuratively, you just invest in things because you've heard of it, because you think they're going to go well. You don't really have the basis. So I started investing. I made my mistakes, my whole lot of mistakes. The most important thing is that after you make a mistake, you need to learn from it and go on. Usually dividend investors, they are conservative investors. They are good investors because dividend investing makes you focus on companies that are usually mature companies. They are companies that have stability. Finance is not supposed to be just about reading financial statements and choosing the right stocks to invest in. It's all about psychology.
Investors, welcome back to another go-round of Masters of the Market. I am incredibly excited today because we have the one, the only Rick Austin on with us. He is a fellow YouTuber, an engineer by trade, an investor, and an e-commerce owner. So we're going to talk about all of that and more to come in today's episode. First and foremost, Rick, I want to welcome you to Masters of the Market. Honor to have you on. I'm going to throw the first question out to you. What's your story and how did you get to where you are today?
Thank you so much, Harry. I'm glad to be here. You have a great show, so I'm really looking forward to it. My name is Rick, as you said. I'm originally an Italian. That's something that probably people just realize after they hear my accent. And I've been living in Italy for the first 23 years of my life. And then since I graduated in engineering, I moved to Germany. As you may know, in Europe, Germany offers better working conditions. So that was my first step into the outer world of my comfort zone in Sardinia, in Italy. And since then, I've been working as an engineer. You said it already. That's we could call it my 9 to 5 job.
Sure.
And apart from that, I've always, since when I was 23, since when I moved to Germany, I've always tried to do something on the side, some side hustle. That's why I also started the Amazon business. It's just a normal e-commerce business when I used to sell different products for like they have products for kids. I don't know if in your audience there is somebody that also is interested in Amazon FBA, but they might know that one of the fields in which you start working on our kids because mothers always buy buy a lot of stuff, and it's a good product niche to start. A couple of years until a year ago, I just have it in standby right now because I've been working on other things like my YouTube channel and
Okay, and your YouTube channel, by the way, if any of you
yeah.
haven't been to Rick's YouTube channel, you have to go check it out. Just a lot
Oh,
of
that's
investing tips, tricks, everything in between. But how did you get take two to YouTuber? I guess take three, right? And engineering to Amazon and now
Yeah,
investing on
exactly.
YouTube.
Yeah, I mean, thank you so much, first of all, for the compliments on the channel. And I'm not at your point right now. I'm just trying to run behind you. But I don't know how actually I started because I guess it was really because of my love for finance. So although I do have an engineering background, I have to admit, since when I was here, like since when I started living independently, I kind of asked myself the question that many people ask, like, how do I gonna survive and how am I gonna get on the right track financially. So you start when you're 25, 26, you start asking your questions like, okay, how do people get rich? What do people do next to beside the normal 9 to 5 job? Like, how do people actually make money? So that's something that always interests me. So I was always really passionate for finance, and I just learned by myself, if I can say so. I learned uh, what are the best ways to invest, the difference between ETFs, stocks. That was all really a secret for me at the beginning. Like people that start investing, they don't really know much about it at the beginning, but actually there is like an open world of sources on the internet. So everybody, the beautiful thing is that although nobody teaches it at school, everybody can actually learn just by himself without necessarily being a financial advisor. And after I learned that, I learned it the hard way. I made a lot of mistakes. I think I started 6, 7, or maybe 8 years ago. I started investing, and like many people, I started as a gambler. Not as a real gambler, but figuratively, you just invest in things because you've heard of it, because you think they're going to go well. You don't really have the basis. So I started investing. I made my mistakes, my whole lot of mistakes. I learned from them. And since I always loved creating content, I always love to interact with people. I love to know more new people, to network with different people from all around the world. Then I said, you know what? YouTube might be something for me. it's a win-win situation. I do get to know a lot of wonderful people, like my audience, and also people in your audience, as far as I can understand from the comments in your videos. And you can also prevent other people from making the same mistakes that you did. And that's the beauty of it, because as a YouTuber, you're not a Peter Lynch that teaches people what's right to do, but you are actually a nobody that made a lot of mistakes and can actually talk about his own mistakes and what he learns from them, so that hopefully other people are gonna start better, avoid making the same mistakes, and have a great financial future.
I love that, man. Before we cover your portfolio, and you talked about just now a lot of mistakes, and which I too, we all have them, right? As investors, when we definitely first
Yeah,
start out, I want to talk about some of the mistakes that you may be alluding to, or what were some of the biggest mistakes that you encountered from the get-go?
I just want to state the obvious first. Like, there are the typical mistakes. One is not starting soon enough. I'm just going to go through them because I'm pretty sure that many people already repeated them in your channel, but not starting soon enough, not taking advantage of the compounding effect that actually just kicks in after 10, 15 years. Whenever you start, and you always feel like you're too late in some way. I studied that I was 28, 29, and was like, you know what? If I only started when I was 18, it would have been better. But you just go on and say, okay, I got that.
Sure.
That was one mistake. Probably one of the biggest mistakes that I've made at the beginning. As I said, I was a gambler because I didn't really know how to pick stocks, how to read financial statements. One of the main mistakes I did was buying unproven companies. You probably follow also Peter Lynch. Peter Lynch said in an interview in 1990, it's really easy to find a company that is going to make money for you. Just look at the financial statements, look how much debt they have. If it's a company with a lot of debt compared to the assets, you're not really going to make a good investment, and it's not that easy. But the important thing is that actually you should always invest in companies that have a solid financial data. They have long-term success. They have growing revenue, growing earnings, at least 10, 15 years of proven public records, low debt compared to the assets. I mean, there are millions of ratios that I don't have to repeat here. But the mistake that I made in the past is I actually listen a lot of what people suggested, of what internet suggested. I listened to the news, if we can say that. So when there was a company that was coming out, an IPO, I would say, okay, this is going to be a great company. I'm going to buy it right at the beginning. It happened, for example, I think it was 2021 with Airbnb. Right now I don't have it, but I did buy it as an IPO. If you know Warren Buffett, like everybody, that he always says, don't buy IPOs because a great percentage of them is going to fail. That's what people never think about. People always think about, okay, I'm going to buy it at the beginning because I'm probably buying it at the lowest price. It's not really like that. When you buy an IPO, you're buying a company that is just getting into the market. Because of the emotional sentiment that develops for a company that is just entering the market, you're almost sure that you're buying an overpriced company at the beginning. Now that's a mistake that I made a couple of times. I would avoid that. Instead, you go for a proven company. If I can give you an example, take Apple. Apple in 2004, so 20 years ago. From 2004 to today, Apple grew with an average of 37% per year. So like an investment of $10,000 in 2004 would have brought you here if I'm correct, to 5 millions. And Apple was already a proven company with great financials since 1980. You had more than 20 years of records of the company.
Sure.
So you don't need to look for a 10x or a 100x right away. You can just look for companies that have a long-term successful track record, learn how to read financial statements, and you're good to go.
So Rick, having that in mind now, is there a way for us investors to circumnavigate this like gambler mentality in the beginning, or do you think that it's necessary to first, begin trialing and erroring and gambling, if you will, to learn that lesson?
I think we need to learn the lessons. I mean, I'm one for action. I wasn't like that before, but now I'm one for action. I'd rather make thousands mistakes and learn from them than have to study for 10 years until I think I'm ready to invest. First of all, because you're never ready. You're never going to be ready. Second, because you want to take advantage of time, and time doesn't come back. And third, because the most important thing is after you make a mistake, you need to learn from it and go on. If you make the same mistakes over and over, then there's a problem. But if you learn from it, then it's good. It's okay. And for an average, let's say for an average investor, or a person that right now is thinking, should I start investing or not? They shouldn't really fear the idea of maybe making a mistake. That's not a problem. If I may suggest, if I were a first-time investor right now, I would probably use a strategy. I call it, the core and satellite approach. I would first try to look for a core position, be it a stock or an ETF, but I would look for something that I know is going to go well. For example, if you're an ETF investor like I am, then I would, as a first-time investor, I would go for something like VOO, like the S&P 500 from Vanguard, or VTI, the total stock markets. And I'm going to have that as my core position. My core position is there to provide stability, to provide diversification, and to make sure that my portfolio in the long term is going to go well. And probably at the beginning of an investing journey, that should be, I would say, almost 100% of your portfolio. Like you need to start with something that is safe. That's
Sure.
at least my opinion, because you don't want to discourage yourself if you start buying companies that lose 30-40% within 6 months, and you don't want to take the risk that you really lose everything. Although even if you make a mistake, there's always a way to earn the money back and to invest more. And the same would be also with stocks. With stocks, I would first go with companies that are like stable companies. I would go for, at the beginning, I would go to growth companies like Apple, Microsoft, Amazon. As growth companies, maybe something like Procter & Gamble, Johnson & Johnson, PepsiCo, whatever,
Sure.
something value companies that are stable. And I would try to build a stable portfolio at the beginning. And then I would also start, taking action, start reading financial statements, start deciding to invest in a company that maybe is not really one of the top 10, and learn from that, because you learn more from experience than from books.
Sure. I think it's this University of Hard Knocks type of degree that I often
Exactly. Yeah.
talk about, right? It's like
Yeah.
you get these
Right there.
experiences. There's your diploma from the University of Hard Knocks. But
Yeah, you
and
can
you
say
it
that.
sounds like you also have, it's probably from your background as an engineer, a very methodical process now laid out for yourself, right? And
That's a
you've laid it out
boring
now for
process.
us.
Yeah. That's a really squared and boring process. I know. That's what wives usually complain about, and they're right.
But I'll tell you, it's the boring is often lucrative. At least that's what I found. Now,
Yeah,
you've
that
mentioned
is true.
ETFs and beginning to build a portfolio with ETFs. I want to ask
Yeah.
you, at this point in time, you're 7 years deep into your investing journey. What type of investor would you say that you are?
Right now, I would consider myself a conservative investor. As I said, I started as a stock picker, 100%. I started by picking stocks, making mistakes with them, and I also got good at that. But with time, I think maybe it's the age. I'm not 25 anymore. I have a wife, I have a family, so you start being more conservative. And I mean, that's a good thing for me. I would always suggest everyone to have a big portion of their portfolio in ETFs, not because you don't want to you want to lose the chance of making great gains. I mean, everybody should have like 10, 15, 20% investing in stocks. Problem is, on the long term, that's an unfortunate thing, but that's the reality. It's really hard to really beat the markets. So that's what I learned with time. I learned that my positions that were based on ETFs, and were basically, as I said, the total stock markets, or S&P 500 plus a couple of sector ETFs, actually did much better in the long term than most of my positions in individual stocks. I mean, I could say that Apple, Microsoft, Amazon, Tesla, other companies that I bought a couple of years ago, they did great. The gain that I got from that kind of got also negatively compensated by also some other losses that I had in bets that I did. So I would say that for the long term, if you also look at the statistics, it's really hard even for hedge fund managers to beat the market on the long term. For a couple of years, you're gonna have 2020, after the COVID crisis. You did have a lot of hedge fund managers that managed to beat the market just because they could invest in great companies with a low valuation. But on the long term, it's safer to just go more into ETF. So I would say that I'm a conservative investor right now, and I lean more to growth than value, because I am conservative, but I do try to I do usually tend to weight more into the growth sector, and that has worked well for me so far.
Sure. So, okay, a conservative investor, that means now we have a longer term timeline horizon for us
Yeah,
set.
for sure. Yeah.
Let's get a little bit here to the makeup of your actual portfolio. Can you break it down for us? What, how many ETFs are in there? How many individual stock positions are in there? What are some of your biggest positions?
Of course, can do that. That's funny because I made a video, I think it was 6 months ago, about my portfolio. And in my video, but back then it was 6 months ago, I think. Back then I had still a lot of positions in individual stocks. It was probably 40%, if not even 50%. I don't remember right now. But in the video itself, I said that until the end of the year, until the end of 2023, I would have moved to 80% ETFs and 20% stocks. And that's exactly what I did. Right now I have it's really around 80% in ETFs. I have 15% in individual stocks. And if we also want to consider crypto, I have around 5% of crypto. It's a different account, but I
It's
also
there.
do have that. And I just keep it at 5%, not more,
Still
because I'm
enjoy
more
that
concerned.
gamble a little bit, huh?
Well, no, I think if you do it in the if you think of the long term, you just say, okay, I'm not gonna buy, what's the name of it, Baby Doge or stuff like that.
Sure, sure,
I'm just gonna go for some stable ones, Ethereum, Bitcoin, Solana, and you do it, but you do it with the long term, because as you know, the volatility there is much higher than in stocks. And my rule that I also say in my channel is always, if you really want to gamble on that, because crypto, it does have I would say, an intrinsic value
hmm
given by the like the whole that's behind the blockchain, and there is an intrinsic value behind, but it's like Warren Buffett says, it's not really like measurable like in stocks. You have financial statements of a company, you know exactly how much they earn, so you can, when you buy a stock, you can actually see it with the side of with the perspective of an investor, of a, of
sure,
a of a person that really buys businesses. So you can say, I'm paying for this stock, I'm paying this price, and I'm getting this earning per share back. You
sure,
can do that with crypto. So just keep it at 5%, 10% if you really want to gamble more because you just want to do the experience. But it's always important to do it only with money that's, in case you lose it, it doesn't really matter to you,
sure.
because it might as well be that you lose it.
Sure. Also, know what you're getting invested into a lot of the times, right? I feel like a lot of investors will, again, hear these
True.
ideas. And I think Bitcoin, there is tremendous value there over the course of time. I don't know necessarily right now, today, where we stand. I think next 10, 20 years, 30 years out, we're going to be in a very different environment. But
Exactly. Yeah.
before getting invested into anything, always do your due diligence. So this begets the question about your process. You have stocks, individual stocks in your portfolio, very conservative with the ETFs. Can you talk to us a bit about your process? How do you go about picking stocks?
Yeah, sure. So it's a different process than what I used at the beginning. With time I learned to read financial statements. I know it's a boring thing for many people, but it's incredibly important. And it's not as hard as people think. Obviously, we don't have the same resources that hedge funds have, but at least we can all read a 10K. I mean, we all have 10Ks available on the internet, so at least you should try to read uh, the main parameters of the main financial data of a company. So that's what I usually do when I invest in a stock. I do two things. First of all, I want to be sure that the company is a stable company, a growing company. So, for example, growing revenue, stable and growing revenue and earnings in the last 10 years at least. Um, Low debt to assets, low debt to equity ratios, because you don't want the company to have a lot of long-term or even short-term debt. The price to earning is also really important information, although you always have to, if you take Apple, for example, and you look at the price to earning ratio, the value itself doesn't really tell you much. It just tells you an information if you compare it to other companies in the same sector. So that's really important. You go and look at the price to earning ratio of the sector where the company that you're investing in belongs to, and try to compare with also the other contenders. This is basically what I do. I also run a discounted cash flow analysis, but this is one of those things that little by little I kind of stopped doing, because I know how to run a discounted cash flow analysis. I know in theory how to get to the intrinsic value of the company, but there's a lot of there's a lot of space between theory and reality. So even to try to calculate the intrinsic value of a company like Warren Buffett does, you're going to have to do a lot of assumptions. And I don't have the means, I don't have the sources to ensure that the parameters that I choose, that the growth that I expect the company to have is really going to be there in the future.
Sure.
So with time, I still use that as a benchmark to try to understand, is this company really overvalued? Is the company undervalued? But lately, I've been investing less and less in individual stocks. So I'm really moving into ETFs, because with ETFs you can actually you can be more sure that you're investing in something that with time is going to grow, because you're not focusing on one company. You're buying a bunch of companies. You're buying a basket of companies that is also going to get readapted and recalculated. And in an ETF, if some companies go bad, they just get kicked out of the ETF during the reconstitution, the annual reconstitution, and then you're going to have new companies getting in. So that's one of the great advantages of ETFs. If you buy something like the S&P 500, you're not going to have just 500 companies that are always going to be those ones. But during the years, whenever some companies lower their market cap because there is less investment in them, because they don't have good financials, the companies are just going to leave the ETF. I mean, they're going to be dropped out of the ETF, and new, better companies are going to come in. So you have the perfect diversification, because that's a dynamic diversification. You don't have
Sure.
to do anything for it. The ETF does it for you.
So I'm curious to know, and you could ballpark this one. What's the total value right now of your portfolio? Again, you can ballpark it if you wish, but curious to know where you're at.
Yeah, sure. So if I take everything together, if I take crypto and stocks and ETF, I'm to ballpark it between 200,000, 250,000. I have around
Okay,
200,000 in stocks, and sorry, in ETF, ETFs plus stocks. I have around 10, I think it's 10, 15 in crypto. It was, I mean, it was 12, 13,000 a couple of days ago. You know how it is with
volatility.
crypto. Yeah. And I got like 20K in a high yield savings account, which usually I don't consider an investment, but you know now they're giving 4 or 5%. So you can also count that as investment if you just block it there. It's always available for the taking. So
Sure.
yeah, in total I'm around that ballpark. Yeah.
So 200, 250,000 around that ballpark.
Something less, it's 230.
Okay. All right.
Yeah.
So how exactly, I mean, it's a heck of an amount. So how exactly would you break down your portfolio now? Let's talk about really like the meat and potatoes here of the portfolio. What are your top 2 or 3 ETFs? And what are your top 2, 3 stocks, individual stocks in that portfolio to get all of us up to 230 plus thousand?
Yeah. So starting with the ETFs, my main position is the S&P 500. I got the S&P 500 from Vanguard, and it's really a huge position compared to the whole ETF part that I have. That's why I told you I'm really conservative, kind of boring being an engineer. I'm sorry for your audience. They're going to have to understand. It wasn't like this before. Maybe they can also check my video 6 months ago. I don't want to lie, but I had like over 40 positions. So maybe if they check that video, it's funnier than now.
Yeah.
No, I have the S&P 500. I have world ETFs, because I also want some exposure to emerging markets and to developed markets. I have in the last 1 or 2 years, I started also investing in Asian ETFs and like East Asia and also Indian ETFs. I invested in a global India ETF that went pretty well, actually. People never think about countries like this, or usually people don't think about India. Now there's a lot of talk about China becoming a great power in the future. It's already on a good way there. But not so many people, I think, give the merit that India deserves, because India is really potentially one of the greatest powers. It's going to be one of the greatest powers in the next 20 to 30 years. They're growing like crazy. And the ETF, the Indian ETF, also in the last 10, 15 years, if you check how it's doing, there's a real potential there. So I have some I would say the global coverage of my portfolio, it's not so high. It might be like 20, 25%. So the
Sure.
rest, the 75% is still American market. Although you can say that American companies from the S&P 500, they are still companies that big chunk of their business is still worldwide distributed. They act worldwide, so you kind of get also international coverage just by investing in American companies. Although you always have to be careful about that. There's people saying just invest in American companies because they sell worldwide. I don't really see it like that. I see that I think that of course American companies do act worldwide. Everybody has an iPhone, everybody buys on Amazon. It's not the same thing. If you go and look at the percentage of business that even an Apple or an Amazon does worldwide, still they do a lot of business in America. So you have to, and these are the greatest companies. If you really go through the 500 companies, around 500 companies of the S&P 500, it's not the same as Amazon and Apple. There are also a lot of companies that just sell in the US. A little bit of diversification with international markets is, in my opinion, a sound decision. It's going to mean that probably you're going to have a little bit more volatility. And probably in the short term, in the next 10 years, it might also be that your performance is going to take a kick.
Sure.
Might be because so far the American market has been better. But as a long-term investor, you think, okay, what's going to happen with China? What's going to happen with India in the next 20, 30, 40 years? And I mean, if you look at how the GDP and everything is growing on those companies per capita, and how the economies are growing, you kind of ask yourself, yeah, is everything that happened in the last 50 years or in the last 70 years or 100 years in America, can we really take all of this and use it as a benchmark to reflect what actually is going to happen in the next 50? Are we sure about that? And I'm really, really confident in America. Don't get me wrong. I'm really confident in America, but how some economies are growing right now, I would suggest every investor to just take a look at these markets, to study these markets, maybe read a book like the book from Ray Dalio. Changing World Order is really focused on economy, and it does depict how the world economies developed in the last 600-700 years. And you can really see it studies a lot of data about China, about India, about all the economies in the world. And you do see how they developed from the early 1920 to today. Kind of gives you a perspective that's not everything that happened in the last 10 years or 20 years or 30 years is going to happen in the same way in the future. You never know how the future is going to be, but you may diversify and also get into these markets.
Sure. Well, it's always interesting. I mean, looking into the future, and we can even see now a lot of companies are heading into India, Starbucks being the latest, 1,000 stores.
Exactly.
India is booming.
Yeah.
Now, yeah, of course, confidence within America and American companies, as Buffett always says, right? If you believe in America, but that's not to say that the rest of the world, right, is just left behind. And there's a lot of really, I think, growth-oriented emerging markets that us as investors should be looking into, bare minimum. I want to go back into your portfolio here and ask you about some of these individual stocks that you're hyped up about, because while you're a conservative investor, you do have a chunk of change in individual stocks. So what are we talking about in that area?
Yeah, that's true. Although most of the companies that I have they're growth companies, but they are solid companies. I have a lot of Apple, Amazon. I got Microsoft. And so this way I cover consumer discretionary. I cover technology. I have Google and Meta for communication services, and that was actually good during you saw what happened to Meta a couple of years back.
Of course.
I kind of lost some of it because you see, mistakes always come and go. I also sold part of my Meta when after maybe 6-7 months it was going down, but still I have some of it. I have some Chinese companies. I have BYD. I bought it at a really good point actually, because I do work as an engineer. I work in the electromobility field. So from the beginning, I was looking at the electromobility markets, companies like Tesla, which by the way I also have. And I was always looking at the Chinese market. So, you got companies like NIO, you got BYD, and I was looking at these companies, which is actually the company that's probably going to be the strongest one in the Chinese markets. And I located it. It was BYD. I invested in it, and it was actually quite good investment. I got some other Chinese companies like Pinduoduo, and I'm not sure if I still have something of Alibaba. It's not really going well in the last few years,
Sure.
but still can happen. I have do have something Indian, but I don't remember anymore. I should check my portfolio more often. I'm focusing on ETF so much that the positions that I have, the individual companies that I have, are actually a bit outdated. Like
Sure.
I haven't bought anything in the last 6 months. No individual companies, only ETFs. So
So while some of those companies they pay a very small dividend, right? Many of them
by the
actually
way,
don't.
I do have companies that pay dividend. I'm sorry. Yeah, I do have Procter and Gamble. I have Johnson and Johnson. I
The
have PepsiCo.
classics.
I have a little bit. They're really classics. They're really classic. So that's why I always say I'm a boring investor, because I did buy a lot of different companies. I never bought a company that was a high yielding company.
Sure.
I usually, never really. I had something on the real estate that really gave. Real estate always gives really good dividend yields, but doesn't always go well. And you know what happened to the real estate market in the last few years. So I did sell a lot of companies this year. So I compensated. I sold some companies that were in loss, and I sold some ETFs and companies that were in positive, so that I could actually compensate the loss with the earnings. But my goal was to kind of get rid of everything that was quite risky in the stocks portion of my portfolio, and get all that amount into ETFs. That's
Sure.
going to give me maybe a lower performance in the long term. I mean, a lower performance in the short term, but I'm gonna be more. I mean, in the long term, I know I can sleep well. I know that my S&P 500 is gonna grow well if the American market keeps growing, and I can sleep better like this.
Look, it's all about, at least for me, sleeping better at night. That's
At
particularly
night, yeah,
why I'm a
yeah,
ETF and dividend investor, right? I really love to
yeah,
sleep well at night. But I'm
yeah.
curious to know from your standpoint, and that's not to say, right? I too have growth stocks, the tech plays in my
Mhm.
portfolio, but I'm curious to know from your standpoint, what keeps you very growth oriented in a lot of these tech stocks? Like, a lot of the times if you say Meta to a dividend investor, they'll panic, right? and
Yeah,
and and that's
yeah.
to say, right, because we all really, really want that conservative approach of sleeping well at night. Why go so much into tech and not go into more of the Johnson and Johnsons, Procter and Gambles, or the dividend investments, or strictly ETFs?
Yeah, yeah. That's a good question. First of all, I do have nothing against dividends. As I said, I also have companies that pay dividends, and I think that also dividend investing is a really good approach, because at least it is per se a conservative approach. Even if you might make the mistakes that you buy a dividend trap or something like this. But usually, investors, if they want or they don't want to say it, they are conservative investors. They are good investors, because dividend investing makes you focus on companies that are usually mature companies. They are companies that have stability. It's not always like this, but with the big names, that's the way it is. And so why do I go for growth? I am a conservative investor, but still I believe that I want to adapt my investing strategy to my age. And although I'm not 25 anymore, I'm 35 right now, still, I think I have a long way ahead of me that allows me to invest in companies that I believe that are going to give a higher total return in the long term. So, as I said, I don't have anything against dividends. What I look at is always that total return. If the company gives me 12% per year, for example, and it does it through 2% dividend and 10% normal capital appreciation, or the other way around, I'm always getting this 10, 12%, that's everything that I want to have. Because if I want to retire one day with a portfolio that allows me to live without any worry, then no matter if I get dividends or if I have to sell portions of my stocks, I'm gonna get to that money anyway. So total return is what I focus on. But I do believe that growth companies in the long term tend to give a higher total return than value companies. Although it's not always like that, but that's at least what I believe right now, because we are getting into in this new millennia since 2000. That's a speculation on my side, so always take it lightly and carefully. But I do believe that since 2000 or even the 90s with internet, we're getting into a new millennium where really technology is going to play such an important role for the future. I mean, I could just give some names like AI, what AI is doing. Although AI exists since 30 years actually or more, But whatever we've seen in the past few years with ChatGPT, with OpenAI developing this ChatGPT that is being used now for more and more companies, for more and more apps and softwares, we've seen like how Microsoft, how Google are getting into AI. It's actually permeating everything. Even Adobe Premiere that I use for editing my video, now the new versions, it's all AI controlled, and that's just one of the example. Like technology right now is showing that through the speed of how it's growing, how the technology sector is growing, you can see that there is a potential that is gonna probably move the working market also in this direction. Like it always happened with industrialization. So you're gonna have jobs that disappear and new jobs that pop up in another sector. With machines, with everything. And right now it's with computers. It's been since the 80s with computers. So there are going to be more and more jobs and new positions, new roles that are going to pop up in the software sector, in the technology sector. And this has to, in the long term, this has to move the bar in the direction of technology a little bit. I can't be sure about that, but my speculation is that the technology sector is going to perform better in the future than it has in the last 20, 30 years. So I kind of want to invest more to have an overweight in that sector than in value companies.
What strikes me is as we go into this master's chat and keep talking, you have so much knowledge and so much
Oh no.
wisdom that you're bringing to the table for all of us, and it's really something unique. And I want to ask you, when you first got started investing, and of course you went to the University of Hard Knocks to go through those experiences and all the mistakes, but I mean, really, and now you got the Ray Dalio books behind you. Where did you start after you realized that the game was on with investing? Did you go right to books? Was there like classes that you took? How can we go about improving our investment strategies and skills? Where did you start?
Well, first of all, as I said, you should always start investing right away without fear of having to read particular books at the beginning. But I would say that I did start with books. Like the beauty of books is that you read a book, it takes you maybe a week if you're a slow reader, maybe a couple of days if you just eat it alive day and night. And in just such a short time, you basically get the whole knowledge that a wonderful profile, that a wonderful figure, the author, got into in a lifetime. So you get an author that needed a lifetime of mistakes, of learning, all concentrated in a book. And we have the privilege just with one single book to get all this knowledge. So I still believe it's one of the most wonderful ways to get knowledge. And I started right away also reading books. I like reading, and I love reading about finance. So there are many books that I would probably suggest an investor to start with.
Sure. Do you have like a top, 2 or 3 that you could share with us?
Sure. So I would say the Little Book of Common Sense Investing from the great Bogle, the founder of Vanguard. That's a book about ETF. So if part of your audience right now that is listening is interested in ETF, I would tell them first of all to read this book, The Little Book of Common Sense Investing. I would also suggest to read the book from Ray Dalio that I told you about, The Changing World Order. It's not really it's not going to give you insights into single stocks, but it's going to give you insights into the economy. That is something that I believe many people ignore because what are we used to? We're used to check the last 10 years. We used to check, okay, what happened in the last 10 years most likely is going to happen in the future. It's not always like that. So it's always good to have long-term perspective. And the book from Ray Dalio really gives you that in such a wonderful way. The Intelligent Investor, I guess everybody that likes investing at least heard about this book of Benjamin Graham. And although I would say for a first-time investor, that might be a little heavy.
Sure.
That might be a heavy read. So I wouldn't suggest it as a first book. And then I loved The Psychology of Money by Morgan Housel. Yeah. The Psychology of Money is a wonderful book. It's also a different perspective on finance, because I think that finance is not supposed to be just about reading financial statements and choosing the right stocks to invest in. It's all about psychology. And that's a wonderful book. If I can summarize it in a couple of words, Psychology of Money shows how the psychology plays a role into investing. You have people that invested their whole life into real estate, what are they going to tell you if you tell them what's the best way to get rich? They're going to tell you real estate investing. Then you have people that just investing in stocks, and they're going to tell you the stock market is going to be the best way to make money. And all this psychology, what the experiences of a person are, they all go through this book. The book is really wonderful. It's a light read, so it's for everybody. It's not a technical book. And then I would say Peter Lynch, like One Up on Wall Street. Like everybody should read One Up on Wall Street. Above all, if you're a stock picker, gives you really good insights into how to choose companies and how to try to beat hedge funds or investing companies. Because summarizing the book, you can't really play their field. You can play their game because it's a different level. So what do? You just find another game to play. You invest in different companies. Because you're not going to invest in companies that Wall Street or invest in companies are going to focus on. So you don't have all this, overpriced companies problem. Really interesting book.
Now, what were some of the steps that you took before you even got to investing? Because it always, for me, especially with someone like yourself, right? It sounds like you were saving before you got invested, and I mean you're very methodical. At least that's what I'm getting from you now. So, can you talk to us a little bit about these steps before someone invests into the market?
Yeah, sure. By the way, that's a good question because I think many people don't really go from being a money spender to being an investor without going through the saving phase. That's actually pretty normal, and that's what I did. I grew up as a saver. I grew up as a saver because of my family. They were savers, like most baby boomers. We can say that.
Sure.
So they were savers. They lived in a different times, and they knew how important it was to just put some money aside for the future. And that's what I usually did in the past. So that allowed me, because I was also working during university, that allowed me to just put a sum of money on the side without knowing that it was getting killed by inflation little by little, because that's something that you learn on the way. Yeah, because that's true. So that's how I started. But then you start asking yourself, what I do with the money. Not that I have such a great amount of money, but I had a small sum, and I asked myself, okay, what's happening with my money? So you start thinking about inflation, increasing prices, about your money that is basically staying the same digits, same number for years, and then you start saying, okay, I need to do something about it, So I started with YouTube. Like many other people, I started listening to Warren Buffett, listening to Bill Ackman, Peter Lynch, and you learn from them. You learn from them, and you start saying, okay, I need to do something about it because now I'm not 20 anymore. I'm maybe 27, 28. I've been saving money, so I don't have the problem that some people have, that they're covered in debt. At least I don't have that problem, which, by the way, is also something that you can fix. But I'm starting on a privileged position because I have no debts. I have some money saved, so I can start playing the game. So that's what I did. I started investing, and it was really a side thing. At the beginning, I really didn't put so much effort. I invested in a couple of companies. I just let it be for 6 months. Just after a while, I started getting a grip of it, and I started liking it.
So I love that. So starting to save money in the process just before you get invested. Now you have multiple years here worth of experience investing and saving. I'm very curious to know if you were to go back in time and tell yourself perhaps just one piece of advice that would have changed the trajectory of your investing journey, what would that tidbit of advice have been?
The greatest mistake that I made, and the greatest thing that I could have done in my past to avoid losing money, was avoiding to time the market. Don't try to time the market. Don't even try. It's a losing game. I had to learn it on my experience many times because, you always have the hope. It's like when you play the lottery, you always have the hope. Come on, I'm going to be lucky this time. But it's really all it is. It's being lucky. If you manage to time the market, and I'm sure that also someone in your audience managed to time the market to say, to sell before a crash or to buy at the bottom of a crash. I'm sure it happens to people. The problem is, what's the probability of it happening to you? And what you learn, there was a study by Schwab. I think it was from 2023 or the end of 2023 to 2022. Sorry, they studied 4 stereotypical investors, and they imagined that this investor went back in time to 2002 or 2003, and they invested a particular amount of money every year for the next 20 years until 2022. And there were 4 different profiles of investors. You had an investor that invested every year the whole lump sum of money on the 1st of January, regardless of how the market was doing. You had a person that instead managed to invest always in the best point of the market. So every year, by luck or by knowledge, you could always invest the whole lump sum of money exactly in the lowest, in the bottom of the market. A third person was always investing in the worst moment of the market. So always every year in the moment where the price was the highest. And then there was a person that was doing dollar cost average also, a fourth investor. So he was always investing every month a 12th of the investment. And then you had a person that didn't invest. And what's really interesting about this study, that by the way, I referenced in different videos of mine, was that all these investors, excluding the one that didn't invest, they all achieved pretty similar results. And that's quite interesting because we always think that if we manage to time the market, that's going to give us a really, really good advantage compared to the other investors. But if you look at this study by Schwab, you can Google it, or your audience can Google it if they want. It was from 2022. You're going to find out that actually, if you just dollar cost average your investment every month, or even you make the mistake of investing always in the best moment every year, but you invest in index funds or ETFs, still the results you're going to get are not so different from the perfect guy that invests in the perfect moment every year. So never try to time the market.
We've heard it here first. Don't try it.
Never try to time the market. It's a losing game.
I want to go here now with a fact or myth type of question for you and ask you, is it a fact or myth here when it comes to the amount of holdings in one's portfolio? Is it a fact that you're well off or better off to have more positions in your portfolio, or a myth? So, some of us, that Bill Ackman approach, right? I think he has 7 holdings in that Pershing Square portfolio versus the Buffett approach, a bucket full of companies, right?
Yeah.
Which approach do we go to? Or Peter Lynch. Yeah, there you go.
Peter Lynch was famous for having for buying everything. Back when he was running Magellan, he was like, every company they would bring to him, he was like, great, buy it. It was kind of like that. That's a really good question, actually, and we have to differentiate if we're talking about ETFs or individual stocks. When it comes to individual stocks, yeah. When it comes to individual stocks, it's a question of how confident are you that your positions are going to be successful in the future. Said in other terms, usually diversification is a good thing. It is a good thing, although Warren Buffett would tell you that it's protection against ignorance. But the truth is, we need to understand and we need to acknowledge that we're all ignorant in some way. We can't expect to have the same knowledge of a person that runs a hedge fund or a Berkshire Hathaway. So the thing is, generally speaking, if I had to give an advice to a new investor, I would definitely say try to differentiate more. So if you just have 5, 6, 7 holdings, it might go well, but you're exposing yourself to more risk because you have just a small number of companies. If one of these companies, if you have 5 companies and one of those go bad, let's say that it goes to 0. It doesn't happen often, but you're going to lose 20% of your portfolio theoretically. And that's just for one company. So when you differentiate, first of all, you have the possibility to differentiate to diversify into different sectors. You have the possibility to diversify into different company natures. You have growth companies, you have value companies, you may have some large cap companies and some small cap companies. So I would always say it's not about being a myth or not. It's about philosophy, the philosophy you want to use for investing. But if we have to just take a bunch of 1,000 people and some of them are going to pick 2 or 3 stocks and others are going to pick 10 or 20, I tend to believe that in the long term, the people that have a little bit more of stocks are going to perform better. Not because they're better investors, but because they protected themselves from big losses more than the others.
Interesting. So would there be a sweet spot for you if you had to advise or recommend if someone was building out this portfolio? What's the perfect amount of holdings to have within a portfolio? And you can include ETFs in there as well.
Okay, if I just go at individual stocks, I don't really have a sweet spot, a sweet number. I would say if you have 20, up to 20 stocks or 25, it starts becoming complicated. it's still manageable, because I do believe that when you invest in individual stocks, your due diligence is that every year or every 6 months you should really take a look at how the financials of the company are going. Are you overexposed on a sector? Are you overexposed on a company, or on a company that is not really performing well as it was 6 or 12 months ago? So you do have all these risks, and to do that, you should actually check the company. So if you have, let's say, 40 companies, like I used to have 6 months ago, I had 40 positions between ETFs and companies. I was well diversified, but I really had a lot of work. So it also comes to the question, do you want to be a passive investor, or you want to be an active investor? Do you want to, I wouldn't say active investor, but do you want to actively check your portfolio all the time? Do you want to make sure that all your positions are still solid companies? And do you want to invest the time in that? Then you can allow yourself to have more positions. You can even have 30 positions, or go to the Peter Lynch level. But if you want to do that, I would actually suggest you to just go the way of the ETFs, because you're going to have a lot of work. If you have 30, 40 positions, you're going to have a lot of work if you really want to do your due diligence. Well, if you buy an ETF, you can buy, my approach would be, for example, you buy as a core position, you buy the S&P 500 or VTI, the total stock market. And then still you can decide to, first of all, invest in some individual companies that you believe in. And second, you can invest in sector ETFs. If you believe that a sector is going to perform better than the others, you can overexpose yourself to a particular sector. And this way you reduce the amount of work that you have to do by a lot, and still you're going to have access to hundreds of companies. It's a really hard game. I think everybody should be careful with stock picking. It's a wonderful thing. I think everybody should do it, at least with a portion of their portfolio, because you gain more experience with that than with the typical passive investing of ETFs. But still, if you want to go to a large number and you don't have the resources that Peter Lynch has, maybe you should think about ETFs.
Now, I'm curious to know from your standpoint here, because you just went through this process of, it sounds like, selling out of a lot of positions that were no longer suitable for your portfolio. From time to time, we all have positions that are in our portfolio that maybe the red flags start to pop up and we need to sell them. How
Yeah.
do we know when to sell? What are some of the red flags we should look for? And when we see them, how do we know really when to just get rid of them?
Man, that's a really great question. And by the way, I think that's one of the things that make that hurt the most to people. When you have
Sure,
something
sure.
that goes down and you don't know where to just get rid of it. That's really a hard thing, because people know that as long as you don't sell, you didn't make a loss.
Sure.
But what happens if the thing keeps going down? It's one of the hardest things. I believe that I think it's called sunk cost analysis. That's when you, and that's psychologically, it's something terrible. When you buy a stock or you buy an ETF, but usually with stocks it happens more. You buy a stock at a certain price, and that price that you bought it for becomes your mental benchmark. So what happens? The company goes down, and you don't think as an investor, you don't think about the financials of the company. You think about, when am I going to get back my investment, get my investment back? That's sunk cost analysis, and it's really, really bad, because it's the wrong benchmark. Doesn't matter how much you paid for the company. At least what I do is I imagine that I don't have the company. Let's say that I have a company that is doing bad. It's minus 20%, minus 30%, and I'm not really sure if I should sell it or not. I kind of reset my mind and imagine that I don't possess this company, and ask myself, if I had this money now that I have invested in it, if I had it now in cash, would I invest in the company or not? So this way, I kind of mentally switch back to my investor mentality, in which I start reading the financials of a company, start reading what the management thinks of. That's, by the way, in the 10K, there's a lot of interesting information about what the company is going towards, like the plans of the company, because you also need to try to understand if the management actually is a good management, if they have good ideas, and you have to try to think about, are these ideas going to work? It's all speculation, but still it gives you an idea of how the company is developing, if they're kind of stagnating, or they're investing in new companies, they're investing in new ventures. So I try to understand how the company is going to do in the future, regardless of the price that I paid in the past, and ask myself, would I buy that now or not? If I don't buy it, usually it's because I think the company is still going to go down in the future, or because the company doesn't really show enough potential for me to be interested in buying it. So in that case, I evaluate the idea of selling.
Now, this
That would
begs
be
the
my
question
approach.
here. How, because you mentioned management, right? A couple of times there. How important is management in the factorization of an investment, whether to buy or even, in our case now, to sell?
It's extremely important actually, but you don't really have so much information about it. That's kind of the problem that makes us more vulnerable to mistakes than a hedge fund or investing company, because we don't have the possibility to go and talk to the company and say and put $1 billion on the table and say we want to invest in you. Let us talk. So we don't have this. The only thing you can say, you can do, you can read the 10K, you can read what the company is planning to do and try to get an idea. But the management per se, now, regardless of what information you can access or you can't as an investor, that plays a really important role in the company. I myself, I'm managing the engineering studio that I'm working on, that I'm working in, and it's part of a big corporation. It's just a business unit of a big corporation, and we've had in the past situation of bad management also above us and a good management, and we've seen what the consequences were for the company and also for the stock price of the company.
Sure, sure.
um, I think that's really important, but I would say right now it's important. But for a normal investor, I would say that you get much more valuable information just by reading the financials. I would tell people, I would suggest people also, that's what I do in my channel. I would suggest people to, keep some information aside. You can go through every detail because it's a losing game. You don't have enough information. So I would say focus on the financials of the company. Take a look at the last 10 years. Use websites like quickfs.net or Morningstar. If you have also the premium account, you have access to all the financial data of the company. And that gives you a more reliable information that's the one that you could acquire on the management. Still, it's an important thing for the success of the company.
Sure. I mean, we have to be able to trust, right, those who are leading these companies to the best that we
Yeah,
can. Now, on
yeah.
this idea of trust, I want to ask you this one. This has been a question I've began to ask a lot of fellow investors and creators out there on YouTube is how exactly do we know who to trust, right? Like you're a creator on YouTube, I'm on YouTube. There's a bunch of us that are creating a lot of content. Some content sexier than others, right? But how do we know like which creators to trust, who to go to for maybe stock ideas or recommendations? Do you have any insights there that you can give us?
Well, I wouldn't mention any YouTuber now, except of course you.
Mention me.
Because if they can follow you and me, they're welcome to check my channel. And of course, every YouTuber. So I want to think in an honest way right now. Every YouTuber tries to do its best to give the most reliable information possible to the viewers. That's what I do. But still, viewers should be aware that everybody can make mistakes. Even financial advisors. I'm not a financial advisor, but even financial advisors would make mistakes. So the due diligence is always due. Like you have to, you can get some ideas, but I would say that whenever you get an idea from the internet, you kind of have to think about the possibility that maybe if people are already talking about it on the internet, it might be too late, or it might be that people are just themselves getting inspiration by others. So it's kind of like a chain of information that goes from one YouTuber to the other. So I would say, generally speaking, it's a wonderful way to get inspiration. But whenever you're interested in a stock and somebody talks about it, just go and read the financial statements. Just think yourself, just turn off the computer, take the inspiration from the YouTuber, turn off the computer, sit down with yourself and ask yourself, okay, what is this company actually doing? Check the financial data of the company and try to never listen to the news. As news, I don't necessarily intend, I don't mean the YouTubers, but I mean like, yeah, whenever there's, look at what happened with AI in the past few years, how many articles in whatever blog we're talking about investing in this company, and now look at how many of these companies actually developed and gave the right performance and how many didn't. So it's always a really risky thing to do. But without that, you wouldn't have any impulse. That's also true. Like, it's true, you have to be careful about the information you get. But if you also don't get any information, you're not going to have the impulse, or you're not going to get to the idea about a particular sector, a particular company. So you have to find the right compromise.
What I really took from that was due diligence is always due. And
Yeah,
I might go, I might steal that
it
one.
is.
That is a great line, and certainly one that I can stand behind. I have two more questions for you. One we're going to zoom out
Sure.
for here. And you've spoken a lot about macros and even Ray Dalio and understanding economies, right? Not just 10 years, decades, right? Dalio
Yeah.
studies decades worth of economies, talks
Decades,
about these
hundreds of
massive
years.
changes. Yeah, there you go.
Yeah.
Wh-
Yeah.
How do you use macros? Do you use macros at all in your investment decisions? Are they a big factor, or do you not really factor them in at all?
So, going, for example, to what you said about Ray Dalio. So it's not just about countries, how they develop. Let's take, just to make an example that probably most of your viewers are going to um, how do you say, are going to feel close to, the famous controversy, growth value. Okay, you got growth companies, you got value companies. What's better? You asked me before, is growth going to perform better than value or not? That's a really good question, because I'm betting more on growth, a little bit more on growth, but I might be wrong. And the reason why I might be wrong is that I don't just look at the last 15 years from 2010 to 2024, where the technology sector, how much it did, like 17, 18% per year on average. But I look at the last 50 years. If you look at the time frame from 1970 to today, it's interesting to see that value and growth actually um, took how do you say, every decade one of these two performed better than the other. So you have a decade of value performing better than growth, then you have a decade of growth, then a decade of value, and now we are in the growth decade. But we've been in the value decade between 2000 and 2010, as well as between 1980 and 1990. And that's really interesting, because usually people just look at what happened in the last 10 years and try to and imagine that this is going to happen also in the future. So that's why, for example, if you look at the technology sector and you look at the price to earning ratio right now, we are sitting at almost 48. I think we are, today I checked it out, it was 47.8. And it's higher than what it was in 2021 before the crash. And it's been the highest price to earning ratio of the technology sector of the last 12 years. 12, 13 years.
Sure.
And that gotta tell you something, you know?
Sure.
So myself, although I invest in growth, I do expect that the growth sector cannot go like this, at least in the next, or the technology sector cannot go like this, at least in the next 3 to 4 years. I expect the price is going to readapt to the real earnings.
Interesting.
And so you kind of look at these macro elements of the economy to try to see how the market develops. You also do the same with market cycles. That's the same, one of the mistakes that people do. You know, people focus on, I mean, they start investing maybe before a crash or right after a crash, and actually to any single part of an economical cycle, there are some sectors that are doomed to perform worse, or some sectors that always perform better in that particular part of the economical cycle. So that's why people should always know how the economy works. How do the economical cycles work of a company? Why do we have that technology performs better right after a crash, or performs better in another moment, and value companies perform better in others? And that should also be a base for us to invest if we want to be successful in the long term.
I got one last question for you. It's my favorite question. I have the honor to ask every guest on Masters of the Market. And now, Rick, it is your turn to answer this question. If I were to give you $10,000 right now to invest in one individual stock, what stock would you invest that $10,000 in, and why?
Wow. I have to decide. I would go for Microsoft. It's a really dangerous answer, but I'd go for Microsoft. I am kind of unsure between Microsoft and Amazon, but I would go for Microsoft probably.
Is there a reason why you'd go more
Uh,
Microsoft than Amazon?
Yes, and also more than Apple. It's just speculation, but if you look at how Apple grew in the last 20 years and how Microsoft grew in the last 20 years, Apple grew much more, and they have a really similar market cap. So you can say they're comparable companies, but Microsoft invested a lot in AI lately. They're positioning themselves in these markets, and yeah, it's kind of a gamble. I wasn't ready for this question. I would have to think about it first. And as you know, I'm pretty squared as an engineer. I don't take decisions if I don't think about it with
Sure.
a coffee at least for 5 minutes.
I see the brain working now.
The brain is working right now. No, but yeah, I would say maybe Microsoft, but it would be a really, really hard decision because. But if I can tell you also some background information, I would go for a solid company. I wouldn't go for a, I don't know, even I wouldn't even invest in a Tesla to give you an example. I do have trust in Tesla, but I would feel it as a gamble right now. So I would go
Sure.
for a company that I know maybe it's not gonna grow as much as some small cap or mid cap company, but I'm gonna be sure that the company in the next 20, 30, 40 years is still gonna be here. It's still gonna sell phones or computers, and it's always developing, always getting better, always investing money in growth, and that's why we get back to the growth uh, discussion
Sure. I love it. So
versus volume.
10K into Microsoft for the long haul. Investors, we have Rick Austin on with us now here on Masters of the Market. Like I said, go check out his channel after this because there is a lot to unpack video to video on Rick's channel. And Rick, thank you again for joining us. And investors,
Thank you.
until the next episode, we will see you all there.